Good morning. It is Saturday, October 15th, 2022. This is Robert Sin at CEO Technician on Twitter, at Goldfinger on co.ca. And I want to start off this weekend's video by saying that this market environment is especially challenging, and there is a lot of noise out there, a lot of content that we can choose to consume, whether it's podcasts or Twitter Twitter accounts that we can follow, CNBC, Bloomberg, et cetera, et cetera. There's so much content out there. So I want to say I thank you and I appreciate your investment of your time in this video, and I don't take it lightly. And I hope that you gain some value, some insight from it. And yeah, I appreciate it. And if you do find some value in this video, please hit the like button and subscribe to my YouTube channel. Follow me on Twitter. Yeah, and let's get right into it. So, first of all, this is a very challenging market environment. So let me just say that. Um, if you don't feel like you have any edge in this market, if you don't feel like you're experienced enough to understand what's going on, then I really strongly suggest just going to the sidelines, just going to cash. I would probably say you're not going to miss anything in the bigger picture until early next year at the earliest. Um, and what I mean by that is, yeah, there's going to be gyrations day to day, week to week, but bigger picture, I don't think there's going to be any massive moves higher between now and January or February in any major asset class or stock market index. We will have 1 day or 2 day rallies, maybe even 1 to 2 week rallies. We'll also have more sell-offs. It's a volatile environment, and it's volatile enough that it can be very confusing. It can be the sort of environment where you can get whipsawed, where you can be bullish 1 day and then bearish the next, and literally buying short-term tops and, and selling into short-term bottoms. It can be very challenging. So this is not for the inexperienced, and even I think experienced veteran traders, market participants are feeling very challenged in this environment. So doing nothing, going to cash is an option, and I think a lot of people have been doing that lately. Cash balances are definitely way up, and we'll talk a little bit more about that later. So market with no memory from day to day. We're getting a lot of sentiment surveys. And I'm not even showing them because there's so many of them, and I'm sure you've seen them. Sentiment is very negative right now, right? Sentiment is very, very negative. You can look at any assortment of sentiment surveys, and they all are in bearish territory. Some are mildly bearish, some are extreme bearish, but they're all negative. And it doesn't. It's not too difficult to ascertain that the crowd is pretty negative on stocks right here. Pretty much negative on everything. They're negative on bonds too. They're negative on gold, and for good reason. All of these asset classes have been dropping all year, right? So normally we think that when sentiment is really negative, that's a great buy signal. True. Most of the time it is. Most of the time it is. Not a exact buy signal, like the sentiment survey goes extreme bearish, you buy that day and it immediately goes up. But within a couple of weeks, that's usually going to mark an important price low, right? Most of the time, that's true. But there are times during bear markets where things can get more extreme and more extreme. Just like during bull markets, stocks can get overbought, quote unquote, and then get more overbought and more overbought. We saw that a lot in late 2020 and early 2021, right? Things can get more extreme and more extreme. So they can get more extreme on the upside and they can get more extreme on the downside, right? So I believe that so far, sentiment readings have not been a value add indicator in 2022. Buying weak sentiment has lost money on net. Okay, but we need to put this into context. Why is this not working? Why is buying oversold charts with negative sentiment not leading to bounces and big rallies, right? I think we need to put it into context where we've come from. The level of extreme euphoria that we just exited 2021 is hard to fathom. Remember, Bitcoin went to 69,000. There was a new investment theme called NFTs, non-fungible tokens. Don't even ask me what they are, but something to do with encryption and pictures of dogs and apes. People were spending millions of dollars on encrypted pictures of dogs and apes. That was 2021. AMC went from $2 to $65 or something. GameStop went from $5 to $500. And I could go on and on and on, right? 2021 was a year of excess, great excess. So the sort of excess that some may have never seen or honestly may have never been seen in the history of mankind. Yeah, South Sea bubble, okay, .com bubble, yeah, they were extreme. But 2021 was right up there. So we're coming off that bigger picture. So to be trying to say that, well, it's just going to be a shallow bear market, right? Or the bottom's in so soon after such an extreme excess is pretty optimistic, I would say. And let me just throw out a caveat. I'm not making any market predictions in this video. I am throwing out some ideas, some observations. And one of the things that I want to say in this video is I'm done with trying to call bottoms. And you might say, well, that's a sign of a bottom. Well, okay, great. I said that about a month or so ago as well. And so far that's been right. Just stop trying to call the bottom. I think that's the start of the bottoming process is when everybody stops trying to call the bottom. So I'm going to start, and maybe everybody else will follow. But I look at Barron's today, and the headline article is why a real bottom could form soon. Okay. So we're coming off this period of excess, this great excess. And so as extreme as it was on the upside, maybe it needs to get to the opposite extreme on the downside. And, it's been ugly. It's been ugly. I mean, Friday's close gagged me with a spoon. It was that ugly. Just, gross. And, looking at like Tesla down 8% last week and actually almost 8% on Friday alone. And look at this downtrend it's in since mid-September. I mean, this is basically over $100 per share drop in a straight line. So it's ugly out there. There's a lot of pain. There's a lot of pain. Make no mistake about that. There's a lot of pain. This is the worst year for the 60/40 portfolio strategy since 1920. So if you're 60% equities and 40% bonds, you're having the worst performance for your portfolio since 1920. And I will posit that the 60/40 portfolio strategy didn't even exist in 1920, but they're just back testing it to see what it would have done in 1920, right? This is a very bad year for financial markets. And it's pretty clear that it is, right? So it's ugly, but there's no real panic or crash. And one of the things I've been kind of joking on Twitter about for the last 5 weeks on Friday afternoon is cue the Black Monday tweets, because literally for the past 5 weeks, every Friday, it feels like we're going into a Black Monday setup. It's been that ugly. Like the market goes out on its lows or it's down big. Nobody really wants to hold over the weekend, or, maybe some people are hanging on and hoping for a bounce on Monday. And it's just like with the right catalyst, the right weekend headlines, we could be gearing up for a panic on Monday. It's felt like that for 5 weeks, but so far it hasn't happened. And there was a few weeks ago, there was the weekend where everybody was talking about how Credit Suisse is going to be the next Lehman. It's going to be Lehman 2.0. And there was some, I don't know, stories put out in Australia that, the management at CS was in discussions to raise capital, blah, 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 sell part of the business. Clearly, I think, CS has some issues for sure. And that could be partially why the Swiss National Bank is drawing on swap lines, with the Fed. But so far, it hasn't proven to be a panic. And it's just interesting how we had Lehman 2.0 weekend a couple weeks ago, and then nothing. The market hasn't been pretty, but certainly there's been no panic. There's been no crash. And there have been multiple 1 or 2 day rallies. Like, look at this full bodied green candlestick, white candlestick, this one, these two, and this one, but interspersed. So there's 5 rally days in the middle of like 15 solid red down days, right? So this is bear market action. Simply put, every 1 or 2 day rally brings back some hope that it's the bottom, and then that hope is quickly dashed. And nowhere else, was it more evident than Thursday, Friday. I mean, we get a big, reversal on Thursday off a gap lower open on a terrible CPI print. We gap a little bit higher Friday morning, and then it's completely dashed as we get economic data. It was the University of Michigan inflation expectations data ticked substantially higher at 10 a.m. on Friday, and it just sell off ever since. Right? It was a selling for 6 hours until 4 p.m. So if I look at the inflation data, the data we got at the end of last week, it's not good. It's not indicative of anywhere near a Fed pivot or a market bottom, simply put. So it's ugly, but there's no panic yet. And so if I go to this chart and I say, well, 2021, let's just say April, May 2021 was the euphoria. And then we go through all of these emotions. And honestly, if I'm talking about the S&P 500, the broader stock market in the US, we might be at the desperation stage, but I don't sense it's panic yet. It's not capitulation, because capitulation would be retail selling everything and swearing off stocks forever. We wouldn't hear about AMC apes if we were in capitulation. So this is interesting. This is George Noble. He's very bearish right now. He's been bearish all year, and he's been right. Um, there are several missing pieces to the low. No capitulation in retail or institutional equity flows. Now, what really stands out to me, and I don't have the data in front of me because there's like so many things I could talk about. I don't want to make this video 4 hours and just drive you crazy that you don't want to even hear it. There's data, you can pull it up on the ARK investment funds, and they've had net inflows in 2022. So look at this performance for ARK. The ARKK ETF is down 64% year to date. So, I mean, I think all of us are probably having a down year, unless you're amazing. You've gotten it, you've nailed it, you're having a down year. But, most of us are probably down 10%, maybe down 20%, maybe down 25%. Okay, it's a really bad year, you're down 25%. But 64%, I mean, that's just abysmal. That's like uh, you should close up shop. You shouldn't manage money. You're down 64%. You should just go on vacation, go get a job at Walmart, think it over for a year. This is what I mean. Down 64% in a year means your career is over in the investment industry, really. But this is net inflows. People are sending money to ARK, to ARK, down 64%. So for us to get to capitulation, people need to take their money out of ARK. And then we'll be closer to a bottom. Now, I wouldn't say that would be the bottom because look, there's one more stage, but we'd be pretty damn close to it. But as long as people are still mailing in money to Cathie Wood down 64% year to date, I'm sorry, that's just not characteristic of a market bottom. So it's an ugly market, but we don't have that climactic bottoming event yet. Okay. And I'm going to skip ahead. A lot of people, and even a few months ago, I think it was in August, I wrote that the Fed would pivot by year end, but I explained that by pivot, I meant pause. So now we need to be very clear. By pivot, we would mean end of quantitative tightening, end of rate hiking, and getting ready to cut, right? That's what I mean by pivot in this video. I don't think we can have a pivot at this point from the Fed until one of these three things happens. And the third one is a minimum of probably 8 to 9 months away. So either the unemployment rate spikes and not just to 4%, but it's going to have to get up to 4.5 or 5%. It's going to have to be substantially higher than it is today. We're going to have to see a major downswing in the labor market where job openings vanish and layoffs start to happen. That would be so. And if that happens, that's a recession, period. It's going to be a recession. There's no moderation in the labor market that leads the Fed to any pivot in the next year and a half that doesn't involve a recession, period. And I think that we should just take that as truth. I don't like to say the word truth because the market is complicated and multifaceted and nobody has the exact truth. But I think that we can say that that's the truth. The Fed is not pivoting with the CPI data that we've had this year and the trend in the data, unless there is a recession and the recession leads to a big uptick in the unemployment rate. Another thing that could cause the Fed to pivot and I mean by that just not hiking rates anymore and reeling back the QT, is if the market stops functioning, right? Just like there's a major panic in corporate bonds, treasury market dries up, there's just no bids, some sort of major market malfunction, sort of like we saw in March 2020, that caused the Fed to come in with unlimited quantitative easing, essentially. And then the other one is just inflation comes down. But they're not going to, even if in November we got a negative 0.1% CPI print, that wouldn't cause a pivot. They're going to want to see minimum of 6 months of moderating inflation back to their 2% goal, right? 2 to 2.5% target range. They're going to need to see minimum of 6 months of that. So we're at this point in time, the best chance we have of a pivot is number 2. But for number 2 to happen, stocks are going to have to be lower than they are today, and potentially substantially lower, like 20% lower. So a lot of, the whole pivot thing, I cringe when I hear people say the word now. A couple months ago, I didn't mind it, and I thought it was a real possibility. But my opinion has changed based upon the evidence. And yeah, if you're a market participant and your opinion doesn't change, your views don't shift over time, then I don't know what you're doing. It's part of the game. You cannot stay stuck in one view, because the evidence changes, the facts change. When the facts change, what do you do, sir? I change my opinion. Simply put, I cringe at the word pivot now. I don't even like to see it. And when hopefully we don't hear the word pivot for another few weeks, and that would be a good sign, a healthy sign, and get us closer to an eventual bottom. But whether the bottom is a month from now or a year from now doesn't matter too much in this exact moment. And so I think that we all need to just stop thinking about a bottom or a pivot, because neither is realistic in the near term. So again, there's no panic. So if I go to the VIX, which is the fear index, which is basically a statistic that tells us how expensive volatility is in S&P 500 options. So the more expensive it is to buy volatility, the more fear that's priced into the market, the more expensive it is to buy put options. So yes, we're at the upper end of the range for the year, but it's not breaking out. It's not making new highs. So while there is elevated fear, this is not indicative of panic yet. If I saw a VIX above 40, I would say, okay, now we've got some panic, but we're not there yet. Now, let's digress a little bit. The macro is driving everything in October 2022. So if you don't understand the macro, then you're at a big disadvantage in the market. And that's just a fact. There's a lot of misunderstandings and misinformation and lightweight analysis out there regarding the Fed, the Treasury, QE, quantitative easing. Let's try to delve into it a little bit. So, what is the Fed? The Fed was created in 1907 basically to backstop the banking system, to make a more orderly, functioning financial system in the US, where if a bank failed, let's say in Arkansas, it wouldn't create a nationwide panic. And so there's all sorts of things that were put in place in the early part of the 1900s, including in the 1930s, to create a safer, more effectively functioning banking system. And so the Fed is, for lack of a better term, the bank of banks. And it can get pretty complicated. We can go really deep into the weeds. I'm not the guy to do that, and nor do I want to do that in this video. But just think of the Fed as the bank of banks. And the Fed essentially has the ability to create money with a keystroke. They can generate new money out of thin air, essentially. But quantitative easing is not money printing. And I know we use this term money printing a lot, and I've even used it in regard to QE. But in reality, at its essence, it's not. All the Fed is doing in QE is creating new numbers in the banking system and using it to acquire treasury bonds, or in 2020 they bought some corporate bonds or mortgage backed securities, right? One of those three things, and usually just treasury debt, right? So they're buying like 2-year notes, 10-year bonds, 30-year bonds, 12-month T-bills. They're buying US treasury paper essentially. And so what does that do? Well, it reduces the amount of those bonds, that treasury debt, available for other investors to buy. So it's putting in cash, new deposits into bank accounts where there would otherwise be investments in MBS or treasury paper, right? So called the portfolio balance channel. It's basically forcing them to invest in riskier assets, stocks. So that's why when QE happens, people think that it's bullish for the stock market. And generally speaking, it is. Because generally, when QE is happening, the Fed funds rate is low, and it's a stimulative monetary policy environment that's pro, risk taking. So just simply put, when there's QE happening, people are more prone to take more risk. And that's generally good for stocks. That's the best way to think about it. It's not really money printing, because on the flip side, the Fed can unwind its balance sheet like they're doing now, and all of those dollars that they sent out come back in. They're sucked out of the system. And then there's more treasury paper, there's more MBS, there's more corporate bonds for sale, right? And so the best way to think about this environment right now is we've just come from, 2020 with all the QE, all the stimulus packages from the Treasury or from the government, fiscal stimulus, monetary stimulus. 2020, we went from an environment where money, the dollar, was very cheap and very plentiful. Now in October 2022, the price of the dollar has gone up. We've gone from a 1/4 point Fed funds rate to 3.25, and most likely by the end of this year we'll be at least 4.5% on the Fed funds. So that's an astronomical rise in the price of money. So, and then the dollar is less plentiful as the quantitative tightening occurs. Dollars are getting sucked out of the system ever so slightly. This is M2. We could go way into the weeds and analyze this with a bunch of other charts, but I just wanted to keep things simple in this video. M2 spiked from, let's call it 15 trillion to 22 trillion from March 2020 to April 2022. But since then, it's come down about 500 billion, so 0.5 trillion. So ever so slightly, M2 is contracting. And look at what financial markets have done. So Fed monetary policy occurs with a lag It has lag effects on the real economy, but the market is hypersensitive to it and has all kinds of wild gyrations trying to get ahead of what the market thinks it's going to do in the real economy, right? So just a little drawdown in M2 money supply, and we've seen a massive move up in the US dollar, a massive move up in treasury yields, and a big drop in stocks with just a little contraction in M2. But clearly the market stocks are a QE junkie. They are stimulus junkies, both fiscal and monetary stimulus. The market feeds off that. And we got a lot of it from 2020 to early 2022. And now the Fed and the government too are trying to make the stock market junkie go cold turkey, and it's not liking it. It's not liking it at all. The Treasury cannot create money out of thin air. The Treasury, obviously, yes, they print bills and coins, but they're printing it based upon the needs of the economy and the M2, money supply. If the government decides to spend more money, the Treasury has to sell more debt to pay for it, or they need to get more taxes to come in to pay for it. The Fed is the only one that can create money out of thin air. And the reason why I'm saying that is because there were some headlines from Yellen on Friday asking the banks if they should step in to make a more orderly treasury bond market. And some people I saw talking about QE. No, it's not QE. Because if the Treasury does that, if the Treasury steps in to the market to buy some, bonds essentially, because I think they would only step in at the long end, maybe 10-year, 20-year, 30-year paper, they would be either using some profits that they received from the Fed to do that, or they would just be issuing more T-bills to pay for it. It's a zero-sum game. I don't know what she means exactly, and there's no point in delving into it until we have more details, but it's not QE. The Treasury cannot do QE without the Fed, period. So there's a lot of misunderstandings out there, and I really don't think we're going to have QE until we're not going to have QE again until one of these three things happens. Now, yield curve control. This is a good site. This is a good article. And it's interesting to read this because it's some history of the Fed. And it's something that I didn't even know. The Fed implemented yield curve control in the 1940s. So World War II was happening. In 1942, the Fed implicitly capped the rate on long-term treasury bonds at 2.5%. So implicitly, I guess, means that they may not have stated it and written it somewhere, but they were buying treasury bonds at the 2.5% mark. So they didn't let the 10-year or the 30-year go above 2.5%. So whatever price level they needed to be at to cap the yield at 2.5%, that's what they did. And so that is debt monetization. So the Fed was actually monetizing the US government debt by buying. So that increases the money supply. You could construe that as money printing. When the Treasury, the government essentially, is deficit spending, and the Federal Reserve is buying government debt that's expansionary, and that could be called money printing. You could say that's money printing, but it has to happen on both the fiscal and monetary policy level in combination, like we saw in 2020. That was one of the reasons why all the risk assets went so crazy, is because they were money printing. They were printing money. So I believe, and somebody asked me about yield curve control, I believe what we're seeing in the mortgage rate, hold on, let me just take a drink. What we've seen just in the last few months is an extraordinary move up. I mean, 5.5% on the 30-year fixed is a high rate relative to where we've been the last few years. Well, 7.08% is extraordinary relative to where we've been the last 20 years. And this has happened really rapidly, really quickly. This is a problem. This is a problem for the economy, okay? And I am wondering, just based upon the Brainard speech, the recent Brainard speech, the Yellen comments about concerns about the liquidity in the treasury market, I'm wondering if there could be some yield curve control coming, just to sort of just to backstop some of the long dated yields, just so that they don't go too much higher, because I feel like this is the upper bound already on the 30-year fix. This is very painful. This is a painful adjustment process. If it were to go to 8%, I mean, forget it. I think home building just completely comes to a halt, and there's no transactions in real estate. Just people aren't buying and selling anymore because nobody can afford an 8% mortgage rate or 7% mortgage rate, and the seller is going to have to take a massive price haircut to do a transaction. I feel like that we're entering a housing market freeze, and housing is the biggest part of the U.S. economy. So if these rates stay like this for another few months, several months, housing is finished, right? And so we will come a lot closer to number one happening, but it's still months off. It's not happening yet. There's no Fed pivot in 2022, period. And really, there's probably not one until at least June of 2023. Now, the market might sniff one out, ahead of time, but in order for that to happen, everything needs to get worse, So we're still in this gap where, for there to be any change in the course of monetary policy, there has to be more pain first. That brings me to the next point. Cash is king when the Fed is raising the price of money. So go to this chart. 2-year treasuries are yielding 4.5%. So every investor has the option to lock up some of their cash in 2-year treasury note for the next 24 months. You put in 100,000 today, 24 months from now, October 2024, you will receive back $109,200. No risk. The only risk you're taking is dollar currency risk, which you could hedge out if you wanted to, or inflation risk, right? But you're getting your principal with interest back in 24 months. And I think for a lot of people, that's a pretty attractive proposition here. With so much uncertainty, potential for stocks to fall even further, getting a 4.5% yield on a 2-year investment suddenly is attractive. We were making fun of and mocking people that were buying treasuries sub 1%. Okay. And Lynn Alden, this is a great tweet. A lot of people were buying treasuries at under 1% yields in the last couple of years. And they've gotten crushed now because of the major, reversal in Federal, Reserve monetary policy stance from being highly accommodative to now being, restrictive. And we've seen this big move up in yields, but this has happened already. We're at 4.5 now. Suddenly, this seems pretty attractive. And I'm not long 2 years. I'm not long bonds right now, but I'm just calling it out there. I think that a lot of people are going to be thinking about taking some of their cash and parking it in T bills or T notes. So this chart helps to put this into perspective, just how bad 2022 has been. Worst year since 1920 for government bonds. So there are some parallels to 2022 and 1920. So World War I ended in 1918, and also the Spanish flu was in 1918. So we're getting over COVID and a worldwide pandemic and lockdowns. And suddenly we have this soaring inflation, just like they were dealing with in 1920. Also, in the late 1940s, after World War II, inflation spiked up. And that's one of the things that's talked about in this article about the Fed and how, the Fed was holding a very accommodative monetary policy stance after World War II. And even 1947, June 1947, CPI hit 17.6%, and the Fed was still accommodative with hugely negative real rates. And then it goes into how there was a major confrontation between the Fed and the Treasury, yada, yada, yada. But this is a very bad year for bonds. So let's go through some charts, and then we'll talk a little bit about where to from here. So yeah, the dollar wrecking ball is the story of 2022. And the Fed, clearly one of the main way they're combating inflation is by strengthening the dollar, reversing the wealth effect. So the wealth effect they generated in 2020 and 2021, they're reeling that back in the hopes of dropping, consumer spending, business expansion, hiring, et cetera, and having all of this weigh on inflation and consumption. And strengthening the dollar is the strongest tool that they have to do that. And they do that by raising interest rates and cutting down their balance sheet through quantitative tightening. We've talked about the S&P and how we've had a lot of 1 or 2 day short-lived rallies, but the broader trend is very clear and quite well evidenced by the quantity of solid red body candlesticks versus the quantity of solid white bodied candlesticks. Bigger picture, we pull it out to a weekly chart. This is now a 50% retracement in the S&P 500. So the March 2020 low was about 2191. The high, January of this year, it seems like forever ago, was 4818. This is the cash S&P, not the futures. And then on Thursday morning, we reached a low of 3491. So basically a perfect 50% retracement. And, some people will explain Thursday's rebound rally as well. Okay, the technicians, the algos covered their shorts at the 50%, retracement, and that caused a big spurt of short covering and drove stocks higher. Maybe that's a good explanation. That could be part of the truth. I also feel like there is some speculation happening in the market that there's going to be some sort of big pivot from a central bank, whether it's the Bank of England or the Fed, what have you, the European Central Bank, that there's going to be something to try and backstop markets here. But so far, that kind of thinking has proven to be fruitless, and wishful thinking. Um, but clearly, we did get a short covering rebound that was very short lived and fizzled on Friday. And that goes back to where I started this, the market with no memory from day to day. You cannot really infer anything about what will happen tomorrow from yesterday. In markets past, and especially like the late 2020 market, when you got a big reversal day or a quote unquote breath thrust, it meant that the probability, the likelihood was that the next several days would see follow through buying. Well, the fact that these breath thrusts, these reversal days have no follow through, tells you everything you need to know about the environment we're in. It's a bear market environment, right? Nothing groundbreaking there, but I thought I'd spell it out a little bit. We talked about ARKK. So this closed at a new 52-week low on Friday. This is not characteristic of a bottom. I mean, stocks and sectors making new 52-week lows. That's not a bottom. Okay, it's not a bottom. They can keep making lower lows. There's no evidence of a bottom, period. And just like I said earlier, the fact that this fund is getting net inflows down 64% year to date tells you there's no capitulation. There's no capitulation here yet. And frankly, while there's a little panic, you could say, well, the UK gilts market, there was panic. The pound sterling, there was panic. Yeah, so there's panics in little segments of the global market, but there's no real panic, widespread panic. And as soon as there was a panic, the Bank of England came in, right, to quell the panic, right? Again, Barron's writing headline articles about why a real bottom could form soon. Again, not characteristic of a real bottom. Tesla, we talked about this big bearish engulfing candlestick on Friday. And so this is going to be really interesting to watch this week because Tesla reports earnings after the close on Wednesday. I mean, you could not get a more bearish end to last week than this attempted rebound. And let's zoom in even more. So, one candlestick means nothing. So, from a technical, analysis standpoint, this is very important to understand. This one candlestick does not mean anything. You need to take it in context. So, Thursday, Tesla printed a bullish engulfing candlestick after having an up day the day before. A lot of people were probably optimistic on Thursday afternoon or Friday morning that that was the bottom and Tesla was now set to rally into earnings next week after this extended sell-off. What happened on Friday? Selling all the way from the gap higher open all the way into the close, completely engulfing the prior day's range. So any bull who stepped in there Thursday afternoon or Friday early morning trying to buy Tesla got the door slammed shut into their face by the close. This is classic bear market action. And just the trend of this chart, the price action we've seen for weeks now, informs me that what Tesla's going to report next Wednesday is not going to be good. Now, let me throw a caveat there. Maybe the stock goes even lower between now and next Wednesday, and the expectations are so low going into the report that when Tesla finally does give the report Wednesday afternoon, that the stock rallies. That's possible. But based upon this price action and my experience as a market participant, this is telling me with a very high probability that Tesla's earnings report next Wednesday is not going to be a good one. Period. Um, and then looking at the weekly charts, a bigger picture, well, I don't need to draw the S, the H, and the S. This looks like a pretty well constructed head and shoulders on the weekly. And it even obeys the classic volume profile where we prefer to see higher volume on the left shoulder, the highest volume on the left shoulder. So you have literally more than 18 months of price action and trading volume, all above basically the $200 level on the Tesla chart. What happens when Tesla breaks down under 200 or down under 190? Then everybody, every single person who's bought Tesla since January 2021 or even November 2020 is losing money. And then if that happens, I have a feeling we'll get much closer to a capitulation. We might even get one. So this is, I really think Tesla is a very important stock to watch next week, not only because they're reporting earnings, but because of the chart, the technical setup heading into the earnings, and how this stock has tended to actually be a leading indicator for the broader market the last couple of years. We talked about the VIX. Now, I'm going to make another video tomorrow focused on junior miners. I didn't want to confuse the two in this video because this was already such a long video. But I do want to just mention gold. So gold chart in US dollars, the only thing you need to know really is the US dollar has soared in 2022. So of course the gold price in US dollars has declined. But look at gold in Japanese yen. It's a completely different chart. And in fact, this is a bullish chart showing an uptrend, and this is a bearish chart showing a downtrend. Now, the dollar sort of runs the world. Unfortunately, it runs the world. It's the reserve currency. It's the currency that most financial transactions take place in. And if you held gold in Japanese yen, priced at however many yen this is, 245,000 yen for 1 ounce of gold, you've still lost purchasing power in 2022 because the yen has dropped, relative to other currencies, and the price of goods in yen, inflation has ticked up in the Japanese economy. So while it looks pretty good just looking at this chart in yen, the reality is that still, if you're holding gold as a Japanese investor living in Tokyo, you're still losing purchasing power. Technically speaking, there's really not much to be too optimistic about here in gold, priced in dollar terms, especially after Friday's action breaking down under 1650. The only small positive is you could say, well, the 200-week moving average is still sloping higher. True, but the daily chart's in a clear downtrend. The 50-week moving average is starting to turn lower, and relative strength is well in bearish territory, but not oversold yet on the weekly chart. So a lot of the things that I said about the S&P can definitely be said very similarly for gold. And obviously, the weekly chart, you can see this now looks like a very clear double top. So I hate to say it, I want to be bullish on gold, but if I'm to be a true technician and read the chart, objectively, it's not good. And we could see under 1600 over the next couple of months. Now, when we do get one of these three happening, unemployment rate really starts to spike, or there's a major market panic, meltdown, or we see inflation really starting to come down, then that will be the time to buy gold. And that'll be the time to call the bottom on gold. But at this point in time, the macro is driving everything. And just to be completely honest, the sentiment and all these things take a back seat to the macro. The Fed is driving this bus and it trumps everything else. It trumps all of those other indicators, all those other tools that may have worked in markets past and cycles past. But this one is all about the Fed raising interest rates and causing the dollar to rally against everything. At some point, and it could be fairly soon, the pain will become palpable and too much, and the Fed will realize it's breaking things and it will rein back in its horns. But until then, and in my mind, until we get an actual panic, they're not going to. So one of these three things has to happen for there to be a big change of trend in all of these important charts. So I think, oh yeah. And then, okay, so the final point. In the short term, so the next couple of weeks, the next Fed meeting is the first week of November. The next couple of weeks, there are no Fed speakers and there's no inflation reports either. There's also a midterm election in the US in 3 weeks. So November 8th is a big election date in the US. So if there were to be a good time for a counter trend rally to happen in markets, in stocks, even in gold, it would be the next couple of weeks before this FOMC meeting, the next one. Because there's not going to be any Fed speakers to talk about how they need to keep raising rates and kill everything. There's not going to be any CPI report that overshoots to the upside and causes a big market down day, right? The conditions are conducive to a counter trend, quote unquote, bear market rally. If we do not get that, then you will really know how bad things actually are. Okay. And I'll wrap up with one more quote. The market will do whatever it has to do to embarrass the greatest number of people to the greatest extent possible. Walter Deemer, well-known technical analyst. And that is what it's doing. Have a great weekend. Thank you for your time. Again, please, if you found any value, if you gained any insights from this video, or you just want to do something to help me out, like this video and subscribe to my YouTube channel or follow me on Twitter at CEO Technician. Have a great weekend. Thank you.